So since the Chancellor's mini-budget on the 23rd of September, the pound has fallen, but it's bounced back roughly to where it was before Kwasi Kwarteng's statement. Borrowing costs, though, remain somewhat higher on wholesale money markets, which, of course, set the benchmark for rates on mortgages and other personal and business loans, with the so-called 10-year gilt rate, trust me, up from around 3.8% before the mini-budget to around 4.2% now. Joining me now to discuss this is Chief Economic Strategist of NetWealth, Dr Gerard Lyons. He formerly advised Boris Johnson when he was London Mayor, and he's also recently been advising Liz Truss, particularly during that Tory leadership contest. Jerry, great to see you. Thank you so much for joining us on your Saturday evening. To what extent do you think the mini-budget was to blame for this financial turmoil that we've seen and the seemingly inevitable U-turn on that 45% top rate of tax?
Well, good evening. It's great to be on the show, Liam. Just to clarify, I'm not advising anyone. I'm an outside economist, but I know that Liz Truss, before she became Prime Minister, asked a few outside economists, including myself, for our views. So important to stress that I'm not advising her. But in answer to your question, I think the mini-budget was this sort of, I won't say the last straw that broke the camel's back, in the sense, as some people have said, I think, as you've touched on, it was a combination of factors, and therefore it would be unfortunate to blame the mini-budget solely, although that naturally contributed to the market turmoil. In fact, there were a combination of factors. The very febrile environment in the financial markets was not helped by a global backdrop where the American central bank was clearly set to raise interest rates, and that was making the dollar very strong across the board. Then on top of that, on the evening of the mini-budget, the Bank of England raised rates by 0.5%, a significant amount. Not as much as some in the markets had hoped for, because on the Wednesday of that week, the Bank of England met on the Thursday. On the Wednesday of that week, the Americans had raised rates even more. So on the Thursday, the Bank of England raised rates significantly by not as much as the Americans. And then also on that same day, the Bank of England said that they would sell gilt government stock, which added to the worries in the market because there was a lot of supply. And then on the Friday, we had the mini-budget, where the Chancellor not only announced what the market had already expected, the energy levy being set, and reversing two big tax increases, national insurance and corporation tax, but then he went that little bit further. So really, in answer to your question, it was a combination of three factors: the global environment set by the Americans, second, the actions of the Bank of England, but thirdly, the mini-budget, and then over the weekend, the Chancellor doubling down to very much defend what he had done in the mini-budget. I think market interest rates would have increased anyway, even if we had not had a mini-budget, but that certainly added to the tough environment we've seen in recent weeks.
Jerry, you're a PhD economist. You've been shortlisted in the past to be governor of the Bank of England. You really are somebody across a lot of the technical detail here, but having known you a long time, I know you're also a very astute student of politics. Do you think the Liz Truss government can ever actually shake off this sense that, as Keir Starmer said, they crashed the pound, they pushed up your mortgage costs?
Well, I think one way to look at it is this, that there were three key target groups for the Chancellor and for the government. And they really covered two of those three target groups, but not the third. The target groups were the general public, and they addressed them through the energy levy, unnerved the general public, as we've seen from opinion polls. The second target group was British business. And what was interesting to note was the three big business groups, the Confederation of British Industry, Institute of Directors, and Federation of Small Businesses, who don't always agree, has to be said. All three groups were very positive and constructive about the policy environment and the mini-budget. But it was the third group, the financial markets. Financial markets were already in the febrile state, and they were already worried about the direction of global, including UK interest rates. So it was that third group that was very much unnerved. And because of how the markets have reacted, that's unnerved the general public as well. So what does the government need to do from here? I wrote an article in the Financial Times today saying very much that the Chancellor needs to focus on stabilising the markets. Therefore, it's very important and right that he's brought forward the announcement of his medium-term fiscal statement. Now, this coming weekend, or next weekend, I should say, the Chancellor and the Governor of the Bank of England are both heading off to the IMF meetings in Washington. These are the big annual meetings. and I think it's important that he again reiterates the message he gave last week in a very good statement, actually, at the Conservative Party conference. At the Conservative Party conference, the Chancellor very much was trying to allay fears about fiscal and financial prudence and discipline. So in answer to your question, I think it's very much about stabilising the situation, appealing to the financial markets, addressing their fears, stabilising that, and then very much providing some context to the general public. But with interest rates heading higher here and globally, it's going to be a difficult backdrop nonetheless, whatever the government says.
Dr Gerry Lyons, Chief Economic Strategist of NetWealth, Economist extraordinaire. Great to have you with me here on GB News. Thanks a lot for taking some out of your Saturday evening to join us. Now, Gerard Lyons there, he mentioned Kwasi Kwarteng's speech at the Tory party conference. I was there, and for GB News, I managed to succeed, as it happens, the only sit-down interview with the Chancellor. I'm just going to bring you just a little bit of that now. I asked Kwasi Kwarteng whether he was surprised by the quite dramatic market impact of his mini-budget. Take a look. No Chancellor, no Prime Minister, especially when they're incoming, mid-term, if you like, wants to see a market reaction that dramatic. What could you have done differently in retrospect?
Well, I think there were things, it was a very quick time that we did it. And also you've got to remember the context. I mean, what was extraordinary about that month was that we had a new government, and also we had the sad passing of Her Majesty Queen Elizabeth II. So we had a nation in mourning. And then literally, I think 4 days after the funeral, we had the mini-budget. It was high speed, high pressure environment. And we could have got, as David Cameron used to say, prepared the pitch a bit better. But what you've got to remember is that 5 weeks ago, we were in the middle of an energy crisis. And the energy intervention actually was the most significant thing that we did as part of the mini-budget. That was the bit that I think we showed real leadership about an energy crisis where people were facing £6,500 potentially in their bills next year. And we intervened.
Kwasi Kwarteng there stressing that his mini-budget was really about that energy price cap. Though, no, that's not part that the press picked up on, or indeed the financial markets. Joining me now, going back to my panel, Justin Urquhart-Stewart, Victoria Scholar. Just a little bit of inside leg info on that interview. It was quite interesting. In the middle of that interview, the security services came in and said we had to stop the interview. And I said, but that's the Chancellor of the Exchequer. No, we need this room, because we were on a building site outside Birmingham. We were at a building site in Sellyoak. And I must say, throughout all of that, a lot of senior politicians, they totally lose it completely, those under a lot of pressure. And Kwasi Kwarteng, it's fine, no problem. So that was quite interesting. But Victoria, he was putting on a defence there. He said the measures were bold, and now he said scrapped the 45% to 40% top rate of tax. What do you think is going to happen on the financial markets next week?
Well, it's interesting, actually, because we're already seeing the pound move lower again. You know, we
about $1.11 at the moment, isn't it?
Yeah, we had that big decline after the mini-budget and then quite a swift reversal. But we've actually seen the pound shift lower again. And this goes to your point that it is actually factors beyond the mini-budget that do actually affect markets as well. Because on Friday in the United States, we had a strong jobs report, and that supports the idea that the Federal Reserve needs to...
US Central Bank.
The US Central Bank needs to move more aggressively to combat its own inflation. And that puts upward pressure on the dollar, and it puts downward pressure on other currencies, including the pound. So some of the pound's weakness that are coming through at the moment is actually also to do with broader global factors. And, you know, we're grappling with inflation and the cost of living crisis, but it is also very much a global issue. We're by no means the only economy to be struggling with rising price levels.
It's worth saying, Justin, UK inflation, even at 9.9%, as Victoria pointed out, it's below the Eurozone average. We thought the UK was going to go into recession. It hasn't so far, according to revised figures from the Office for National Statistics that have recently come out. And the UK's debt as a share of national income, government debt, is actually the second lowest in the G7. Only the ultra-prudent Germans are lower than us. And yet, as Victoria points out, the pound is falling, the dollar's going up, and that falling pound, it's not just about if you're going to Florida to Disney World, you know, at the exchange markets, oh my God, I've only got this many dollars. If the pound falls, that leads to more inflation because our imports become more expensive. And that's why it's an important part of this policy-making conundrum.
You would think the points you just made there, they're all strong points as to why actually the UK economy should actually have a bit more support. But despite that, there was still weakness. And the reason is primarily, I think, just in terms of overall confidence. We wanted to have someone who's going to give us stability. Show stability. Yes, we're going to have some interesting changes and moves, but don't worry, this is a strong, steady hand. And actually, I'm afraid all we got was people trying to be dynamic, probably trying to show off a little bit too much. And the result is, I'm afraid, the markets just didn't believe.
I'll tell you what I thought happened. I mean, the markets in Asia, they could see that the British press was going to go nuts over this 45 to 40% tax cut because it was just politically inept and ill-timed. So in quiet moments throughout the 24-hour cycle, because currency markets are always open, they're not like shares, currency markets are always open, they thought, I'll tell you what, if we get a lot of money short of the pound, if you like, trying to push the pound down, then you're going to get a doom loop, aren't you? The pound goes down, the papers go even more crazy in the UK, the pound go down some more, and the people who have shorted the pound, bet against it, making money from its fall, make even more money. I mean, am I overanalyzing this, Victoria?
I think, sort of to the point that we were discussing just before, confidence is such a massive issue. We know
that's driven by the press.
It is, and you know, we know that consumer confidence is at a record low with the cost of living crisis. Yes, the headlines certainly don't help with sort of the doom-mongering. And yeah, I mean, this is the thing with financial markets, is that they are driven by sentiment.
Fear and greed.
Fear and greed. So when we see a sell-off, actually what we typically see in markets is we see very sharp moves lower because that's prompted by fear.
And emotion.
Emotion. And then we sort of see slow grinds higher. So that sort of move down.
The kind of saw edge that you see in financial markets.
Exactly. So we do see those very quick moves to the downside, and that's because there's a lot of human emotion involved in financial markets.
Well, it'd be interesting to see, wouldn't it, in the next few weeks when we start hearing some comments from some of the market participants, how many actually did sell short and then buy back 12 hours later and actually just really made some advance on it.
It's like people who watch the Beatles at the Cavern Club. They all say that they did, but did they actually?
We'll find out eventually.
We certainly will.